B-Y-O-B. Be your own bank. I have a lot of people that ask me, what does this mean? Well, that's simple. Mimic what a bank does. Do what all banks do. But you might be thinking to yourself, I don't have a degree in finance. I'm not even good at math. I don't really know what banks do. How can I mimic the bank and be my own bank when I don't know anything about this? Well, that's exactly what I'm going to show you today. I'm going to show you that by changing just one thing and adding one step will allow you to do what the wealthiest families throughout history have done. How you can be your own bank. My name's Chris Naugle. This is What Now? What's next for you to be the bank? So in order for you to become your own bank, it'd be very important for you to understand, how does a bank actually operate? And that's very simple. I want you to think about what you do every single day and every single week. You probably go out and you trade hours for dollars. You work a job or you own a business. But one thing is the same for all of you. You make money. And when you make money, what do you do with that money? You take this money, and I'll bet most of you go and take the money you earn and put it into someone else's bank, whatever the name of the bank is that you deposit your money. Now, when you put the money in their bank, what happens? Well, the first thing that happens is hopefully the bank pays you interest on that money. And that makes you feel good, doesn't it? No. But if the bank pays you, let's just say 1% on your money, and if you're earning more, that's great. Do you think the bank lends your money out at a rate lower than what they're paying you? Absolutely not. If the bank's paying you 1%, the bank will probably lend that same money back to you or anybody else at a rate of 5%, hypothetically speaking. So let's just do some simple math. If the bank were to lend your money out at 5% and the bank paid you 1%, how much did the bank make in between? They made 4%. We call that 4 points. That is a 4-point spread. The bank made 3 times more money than you did. Simple mathematics. They paid you 1%, they charged you 5%, they made a spread in the middle. That's what banks do. But you see, some of us actually think that when we take our hard-earned money and we deposit it in the bank, we think that that bank takes our money, puts it in a little black box back in that vault with your name on it, right? Is that what the bank does? Heck no. The bank makes your hard-earned dollars go to work for them. And you know who allowed that? You did. When you signed the account opening forms, you gave the bank full control of your money. Literally, the bank can do anything they want with your money. And what do you get for that? A return and this nice, warm, and fuzzy feeling that you can go back and take your money anytime. But that's not even the truth, is it? Because I'll bet if any of you have any kind of money at the bank and you went in and tried taking all your money out, I'll bet you the bank said, sir or ma'am, we can't give you all your money today. You'll have to come back next week and we can do that. Or you'll have to call ahead and let us know how much you want to take out. Now, that's not liquidity of your money. That's you having to literally ask permission to get your money back. But the money you gave up control of that the bank now has, the bank makes that money go to work for them. They lend that money out. And usually they lend that money out in conservative types of loans, like mortgages and car loans or boat loans or tractor loans, things that have collateral, and the bank takes a collateral position in those things that they lend money on. In other words, if you don't make your mortgage payment to the bank for a long enough period of time, what will the bank do? The bank will foreclose on your house and take your house from you, no matter how much equity your house has. That's because the bank is the one in control. So if you wanted to learn how to be the bank and how to take back control of your money, well, then we must understand that you have to change one thing, folks. And that one thing you have to change is simple. It is where your hard-earned dollars go first. because we don't want to put it in their bank. We want to put it in a place where your hard-earned dollars can work for you. So if we're going to talk about where your money should go, let's talk about a fictitious place. Like, let's just call it like the perfect place you could put your money. So let's get into this. This is fun. If you could just design the perfect place to store your safe money, your money that normally would have went to a bank, what would be some of the things you would want? Let's do this together. How about guaranteed interest on your money? Like, they can never change, right? Not this crap that the banks do where they pay you 5% for a couple months and then the Fed reduces rates, and what happens? The bank reduces your rate. No. We want a place where we can put our money where we get a guaranteed interest rate for the rest of our life. Yeah, that sounds good. Well, what else? Well, I don't know. Let's allow our money to also earn dividends. Yeah, that'd be cool, wouldn't it? Every year, whatever money we have in there, we get paid a dividend, and that money just increases the amount we have. All right, yeah, so guaranteed interest plus dividends. What else would be really cool? Well, how many of you like paying taxes? What if the interest and dividends we earn in this perfect hypothetical place, what if that money grew tax-free? Wouldn't that be cool? Yeah, that'd be really cool. But you know, in the bank, you have liquidity. You can just take your money out. So this perfect place that I'm talking about, this one change, well, that should also have liquidity, right? So if I take my hard-earned dollars and I put it into this place, I want to be able to take that money back out anytime without any questions. I don't want to walk in and say, hey, I want my money back. And the bank says, well, you're going to have to call in advance and we're going to have to process that. In other words, we don't have any money in the vault, so give us a few days to call the Fed and get some more money, right? That's what they're saying. No. We want to have immediate access to our money. And what is immediate access to you? Well, to me, it'd be like 36 hours, right? Like, I put money in and I just click a button and the money is right back where it came from. Wouldn't that be immediate? Yeah. Well, we could do that, and in the 36 hours, our money would be back and we could use that money. Now, it might not be 100% of the money you put in there because we got to leave a reserve, right? If we're going to create this perfect place, we don't want all of our money to come out if we take it out. We need to leave a reserve. So what if we had access to, let's just call it 90%? Would that be cool? I'd be okay with that. I mean, it's probably rare that any of you have money in the bank and you just go in and take 100% out just to say you can, right? You take out what you need and you usually leave some money in the bank, don't you? Okay, so let's just go from the top. We get guaranteed interest in this place. We get dividends. The interest and dividends grow tax-free. We have access to about 90% of that money anytime we want without any questions. And what else would be really cool? Well, how about protection? So if for some reason someone slips and falls at your property and they sue you, well, we don't want them to have access to that money. We don't want to get sued and have to give them our hard-earned money, right? So protection against judgments and liens would be pretty cool. Well, okay, let's make that one of the things. Protected against judgments and liens in almost every single state in this country. But let's really make this fictitious, right? Now, let's just say we put our money in this new place. And let's say we need that money and we take that money out, the 90%, and we use that money to go invest in something else that's going to make us a higher return. Now, wouldn't it be cool if when we took that money out, the place where that money was continued to pay us interest and dividends on the full amount, even though we just took most of it out? That would be freaking sweet, because that would mean we are now earning uninterrupted compounding interest. And Albert Einstein said that was the eighth wonder of the world, the most powerful thing in the financial world. So come on, you all must be saying this sounds too good to be true, but let's just add one more thing while we're at it. Let's just say we put our money in this place and I don't know, something tragic happens. We pass away. We go on to heaven. I like to call it graduate. And now our family is going to need to maintain and continue their lifestyle, but my income's gone. Wouldn't that be cool if the money just multiplied, kind of like the Gremlins movie when they got a little water, they just multiplied? Yeah, so if we die, we had 100 grand in this place, and now all of a sudden our family gets $1 million, hypothetically. Wouldn't that be freaking sweet? And it wouldn't even be sweeter if our family got that money tax-free. I mean, come on. That all sounds perfect, doesn't it? It actually sounds too good to be true. And I hear this all the time because remember I said, in order for you to be the bank, you must take back control of your money by changing one thing. And that is changing where your hard-earned dollars go first and Everything I just told you exists and has existed for hundreds of years. As a matter of fact, the wealthiest families in history have known about this and used what I'm about to teach you for a very long period of time. Oh, what family you're asking? Well, how about the Rothschilds, Rockefellers, Morgans, Stanleys? How about Ray Kroc, Walt Disney, and our sitting president? Yeah, even him. Yeah, those are all wealthy families and they've all used this. They call it privatized banking, but they all changed one thing, and that was where their money went first. And they all got all those fictitious, awesome things I just said. So what is this awesome place? Well, in order for you to be your own bank, and in order for you to take back control of your money, you would need to set up a different account. But it wouldn't be with a bank, it would be with a giant mutually owned insurance company. That's right. So what is this magic place that I just mentioned, and the place that all these wealthy families use? It is a specially designed, I want to preface, specially designed, because that's very important. Specially designed and engineered whole life insurance policy from a mutually owned company that pays dividends. Yep, that's exactly what it is. And yes, it does everything I just mentioned. Oh, you already forgot? You know, it's kind of funny. People have short-term memory. Guaranteed interest, pays you dividends every single year. The interest and dividends grow with uninterrupted compounding interest. Its growth can be tax-free internal buildup of the cash value if designed properly. Yes, you can use that money anytime you want, but when you use it, you take a loan from the insurance company. I'll cover that in a second, because now you're like,
oh, I knew there was a catch, yep.
Yep, so you put your money there and you gotta take your money back out by taking loans. And yes, those loans do cost money. It's simple interest. But hold on. If you understood math, that shouldn't be a problem. Because if your money was earning guaranteed interest plus dividends at a higher rate than what the insurance company charged you on the money to take it out, what would you be doing? Well, remember how a bank makes money? Remember the spread? Yeah, bank pays you 1, they charge you 5. They make the spread in between. Well, the insurance company pays you more than what they charge you to use your money, meaning you make a spread. But the best part about the spread is every single year it goes up. That's just math too. Albert Einstein knew this well, and I want you to understand this well too. That is called uninterrupted compounding interest. Remember, when you take money out, you're not actually taking your money. That's why all your money stays in that specially designed whole life and earns interest and dividends uninterrupted, because when you need the money, you take a loan from the insurance company's general account. Actually, what the insurance company does is the insurance company guaranteed you 2 things: interest and a death benefit when you die. So what the insurance company does, in their ultimate wisdom, is they subtract the loan from your death benefit. That's right. So if you died the next day after you took a loan, they would pay out the death benefit minus the loan balance. That's how they do it. So your money never got interrupted. It just collateralized the loan the insurance company gave you, and you got to be the bank. Why? Because you were in control of the money and you earned a spread on that money, but it gets even better. Now, let me just pause, because now what I'm gonna do is I'm gonna explain to you one of the most important things that you'll learn in this video. Because up to this point, the only thing I've talked about is a product. I haven't even begun to tell you how to be the bank, which is a process. Banking, make no 2 ways about it, is a process, not a product. But before we get into that, I want something from you. That's right, if I'm gonna give you this ultimate knowledge, I need you to do something for me. And it's simple. Right here, there's a subscribe button. Click that subscribe button, and that little bell up top, smash that bell so that you're notified every single time I put a new video out, because there's lots of good videos that teach you this. Now what I wanna teach you is something incredibly valuable. Something that I learned from a gentleman by the name of Brent Kessler. But Brent Kessler learned it from a book that I also read called Becoming Your Own Banker by R. Nelson Nash. Check it out, it's right here. This book explains what he deemed the infinite banking concepts, which is a process. And let me tell you what the process is. It's a process of you taking back the banking functions in your life. So let's get into it. Taking back the banking functions in your life. Well, think about that. I showed you the first step to that, which was changing where your money went first so that you could actually be in control of it and make a spread on your money just like a traditional bank does. But what I didn't explain in that first segment is the process of banking. And if we're gonna take back the banking functions, well, then you need to understand what that means. Because up to this point, when you need money for a new car, a mortgage, a tractor, a boat, maybe a line of credit, whatever it is, or even those margin loans in your brokerage account to buy more stock using borrowed money, you do all that using somebody else's bank. And when you borrow money from somebody else's bank, what must you do? Well, if any of you said you must make payments back to that bank that you borrowed money from, you are right. But those payments that you make back, what do they include? Two things: interest and principal. In most loans, not credit card loans, but most loans, when you make payments back on a term loan, you are paying back interest and principal with every payment you make. So if you're gonna take back the banking functions in your life, all you would need to do is find a way to make those same exact payments for the cars, the boats, the tractors, the margin money to go buy more stocks or crypto or whatever the heck you invest in. You would just make those same payments, but you'd make them to yourself because you effectively have created your own banking system. And here's how it works. So I'm just gonna do this visually, so just follow along on the screen. I'm gonna keep this at a 5th grade level. I already explained to you why you would want to change where your money goes first and put it into a specially designed and engineered whole life. Now, if you didn't catch that, please rewind this video, go back and watch that whole part where I explain all the things that a specially designed whole life policy gives you that a bank doesn't. So now our money is on this side, sitting in a specially designed and engineered whole life. And every single year, you're gonna save new money inside of that specially designed whole life, just like up to this point, you were saving money in somewhere like a bank account, a 401k, a brokerage account. You're saving money. You just changed where your savings went first. And now it's in a specially designed whole life, earning all those things. But now you want to take back the banking functions in your life. So step number 1, over on this side, so just think of a circle. Here we go. See the circle I just drew? We got a circle. We want our money to go around the circle, but we always want our money to land back in the same place. And when it makes money over on this side, we want that money to end up back in our bank, not their bank. So if we're gonna take back the banking functions, let's look at where you're leaking money today. And I always say, start with your debts and expenses. So who do you write checks to every single month? Think of your debts first. You probably have a car payment, maybe 2, maybe even 3 in your household, right? How much do you pay to those car payments? Yeah? Wow, that's a lot. Put it down in the comments. How much are you paying for all the car payments in your household? Now, let's just say our bank, that specially designed whole life, through all the savings, we have accumulated enough money in our bank to pay off their bank. We want to start paying off those car loans. Now, what we do is we take the loan from our policy, our bank, instead of theirs, and we pay off that loan. So we pay off their bank with our bank's money. Now, when we do that, some people stop there because they think they've succeeded. You have not. Yes, all of the money is still in your policy earning interest and dividends, but now what we got to do is take back the banking functions. And the banking functions up to this point were being given away in the form of monthly payments. So now what we're going to do, remember, over here, you were making monthly payments on those cars. Every month you were doing it like clockwork because you didn't want to stop making those payments and have that tow truck show up at night. So what you're going to do is you're going to make those exact same payments you used to make to their bank, but you're going to make them to your bank. Go around the bottom part of the circle. Every month, that payment ends up back in your bank. So each month, just think that check is still being written. You can do a bill pay, write a check, do transfers, however you want. It's just all coming back into your bank. And every payment included what? Interest and principal. So whatever interest you would have paid to their bank now comes back to your bank. You now have closed the gap. All the money is now in your circle, in your control, and you are making the spread, not them. Because if you were making car payments and they were charging you 6% and you were able to use your money at 5%, what is the spread? 1. You made a spread on your money, didn't you? But you see, remember I said earlier in this video, your spread goes up every single year. Why? Well, remember this side, that specially designed whole life? What did I tell you it does? It grows with uninterrupted compounding interest. So whatever that amount was we took out to pay those car loans out, that money's still in your account, earning interest and dividends at a rate of, let's just hypothetically say you got an insurance company with interest and dividends that pays 5.5. So 5.5. Okay, you took the money out and you paid the insurance company simple interest of 5%, but you were giving away 6% interest on those car loans. So 6 minus 5 is the 1% spread, but you see you made money twice on the same dollar, not once. So you didn't just make 1%, because that wouldn't get you excited, would it? You made 1% plus your money is still earning interest and dividends. Are you picking up what I'm putting down? Now, the fastest way to build wealth, let me tell you that, and this is just banking 101. The fastest way to build wealth is to take back the money you're giving away through your debts and expenses. So whatever debtors you have, what we're gonna do is over time, and it does take time, we're gonna keep doing that. We're gonna keep taking loans from our policy and paying off those loans from other banks. And every time we do that, we're gonna create the ability to recycle and recapture the money that you were giving away in monthly payments, which are principal and interest payments. And every single time, you make the same payment back to your bank for the same amount of time. And as you do this, you are building wealth. Let me just give you an example. Picture a credit card. You probably have one, right? When you get your credit card statement or you look at it online, what is the interest rate the credit card company is charging you on that credit card loan? How much is it? Now let's just dissect this. Your credit card charges you 20% annual. So every year you're making payments to that credit card, trying to pay it off. So every year, if you make payments, you gave away 20%. What would you do to make 20% on your money? Wouldn't you invest in really risky things trying to make 20%? Because that's a good return on your money, isn't it? But you don't have to take any risk to do this. Just pay off the credit card and make the same payment you were making to the credit card back to your policy as a loan repayment. You effectively recycled and recaptured not just the cash flow you were giving away, but also recycled and recaptured the 20% in interest you were giving away. Because now the payments come back to your account, and that is the same as making 20%. But you didn't have to work any longer, you didn't have to work any harder, and you didn't have to take on any risk. You just took back the banking functions in your life. And through doing that, you also started to build wealth through your own debts and expenses. Now, eventually, if you do this properly, which is what I'm teaching you to do, all your debts will be gone. You will owe no man nothing. And now all of a sudden you'll have all this money inside your policy or policies, and you'll need that money to go somewhere. So now let me revert back to, how do you become your own bank? Well, you mimic what a bank does. You do exactly what the bank does every day. And what does the bank do every single day? Do you remember? They make loans to people like you and me. So if they make loans and you are trying to mimic them, well then yes, you should make loans as well. You've already paid back all the debts. So now let's just copy the bank. Now, one thing that I've done, and I'm not going to say this is what you should do, is I have started to lend my money on real estate. Why? Well, because I know, like, and understand real estate. And whatever it is you're going to loan money on, it is something that you should know, like, and understand. So in other words, if you're in the trucking business, you understand trucks. Maybe you would lend money to other truck drivers so they could buy trucks, and you would take collateral of those trucks. If you're in the car business, maybe you would lend money so people could buy cars, and you became the bank on those cars, and you took a lien position on the car. So if they didn't make the car payment, well, what would you do? Well, you would send the tow truck to pick the car up, and you would repo the car, would you not? Me, I lend on real estate. Remember the circle? I take money from my policies and I lend it out to people that need money to do investment real estate. And I do my due diligence on the real estate, making sure that I have substantial collateral. In other words, if they don't pay me, what I do is I foreclose on the house, and now the house becomes mine. Plus all the payments that they made to me in interest, I get to keep all of that. You see, this is what a bank does every single day. And banks don't like taking risk. So they collateralize almost every loan. And you know what else banks do? They ask you to personally guarantee the loans. So even though they're gonna take back the asset through a repo, a foreclosure, or whatever, but they're also gonna go after your personal assets. Oh yeah, they don't just stop at the asset. They don't just take your car. No. Then they go try to garnish your wages and try to do all sorts of things because you personally guaranteed the loan. So if you're going to mimic what a bank does, well, then you should have your loans personally guaranteed and collateralized. Listen, folks, I'm just telling you what you already know. Remember earlier, I said you don't need a degree in finance. You don't need to understand banking. You just need to understand what you do every single day with the banks. You deposit money and then you borrow money from the bank. And the bank is the one that wins. As a matter of fact, if you go to bauerfinancial.com, you will find that there's not a bank in this country that makes less than 400 to 1,300% more than you do on the deposit you leave there. That's right. The spread the banks make is always going to be 400 to 1,300% more than you're making from bank interest. I know, let that settle in. And if you don't believe me, just go to that website and check it out. So listen, in conclusion, I just showed you how you can be your own bank. It is literally as simple as changing one thing and adding one step, the process, the circle. Just in your mind, just think of the circle. There's a little bit more to it than that, but not much. And the only thing I would say to that circle is in the middle, just draw 2 lines. So you got a circle with 2 lines down the middle. Now that little sliver in the middle, what is that? That is a segregated bank account. Now, I didn't want to go into this in this video, but you must understand, your money when it leaves the policy has to stop at a bank. Think of this as an airplane. When you're going to fly anywhere in the United States, especially from Buffalo, New York, you have to lay over somewhere. Now, you're not at that layover point for long, right? Usually you get off the plane and you're walking really fast to the next gate to get back on the plane to go to your end destination. Well, this middle piece, the segregated bank account, is nothing more than a stopping place because the loan comes from the insurance company. It has to stop at a bank. And then it goes on to its final destination, paying off debts, investing, lending, whatever it is. And then when you take those payments to recycle and recapture them back to your bank, they have to also come back and stop at the bank, that segregated bank account, and then proceed back to the policy to repay the loan. So why must we still use banks? Well, because that is the books and records for you. You see, if you're going to be a successful banker, you need to understand books and records. So what I would suggest to add to this entire process is go to your local bank, wherever your accounts are, and open a second bank account. Now, this bank account is just going to be that stopping place because we want that for books and records. Every loan you take from the policy is going to stop off at the bank. You have a record of that loan. And then it's going to proceed on to that opportunity. You have a record of where that money went. And every payment that comes back is going to stop off at that segregated bank account. You have a record of that month's payments. So now you could just look at that bank account and you could say, oh, they didn't make the payment this month, or oops, something didn't happen. Then you know exactly what to do next. Books and records are important in banking. And if you're going to be the bank, you must mimic the bank, which means you must have books and records. So I just figured the simplest way to do this is that segregated bank account. So again, circle, money starts on the left, moves over to the right. We call that opportunity zone. That's where your money's going to earn a higher interest rate than what the insurance company charges you. So if the insurance company charges you 5% simple interest on the loan you took, your money should be working at least 5+%. Okay, so if you were to pay off a loan, make sure that that loan that you're going to pay off with your bank's money is higher than the cost of your bank's interest rate, which is 5% simple interest. Okay, so now that you understand how that works, you have taken a very important step in learning how to become your own bank. So at this point, I think you've probably got a pretty strong grasp on what becoming your own bank looks like. Change one thing and add one step. So you might be asking, what's the next step? Well, that's easy. Right in the description, there's a link. And if you click that link, it will allow you to book a call with one of our money mentors. Now, the money mentor call, let me preface, is not a sales call. They're not going to try to sell you anything. Instead, what they're going to do is they're going to try to figure out what problem this banking system can solve for you. Maybe it's paying down debt. Maybe it's how to just earn money twice on the same dollar. Whatever it is, they're going to identify that and they're going to go into detail. But they're also going to talk to you a little bit about how this process can work to solve that problem for you, showing you what that specially designed whole life will look like. But they will also send you a sample report of showing how the infinite banking concepts, the process, will work with your individual illustration. Now, The next step would be you would go through an application call. That application call is very simple and it will just ask basic questions. This is where we're submitting all your information to the insurance company to see if you can even get the policy. That process can take anywhere between 2 days and as long as 84 days. Yes, it's a long process because the insurance company needs to make sure that you look as good inside as you do on the outside, and then they'll issue the policy. And during that underwriting process, what we've seen is about 8% of all the applications, which are thousands of them, 8% will not make it through. But that's okay if they don't because we have a solution there, but that's for another day. So now your policy is issued. You're ready to start your own banking system. What are you gonna do? Well, after you fund the policy, you're going to work with our implementation team. And that team is designed to help you put the rubber to the road for your banking system. They're literally gonna just hold your hand and walk you through the steps to get the first loan out and to start recycling and recapturing the money. And they're gonna lay it all out because that's what the report does. Folks, we don't just help you with the policy, we actually help you get started with the infinite banking concept. And we help you become your own bank. I hope you enjoyed this, and also one other thing. Some of you might need a little bit more. So if you do, you're gonna wanna check this video out right here. It's the 90-minute money multiplier video, the OG video that we've created. Check it out, this is a brand new version, and that will explain the entire process so you will feel totally confident with this decision. My name's Chris Naugle, and thanks for joining me for another What Now? What's next? And what's next is you are going to become your own bank. See you next time.